Hi, how's it going everyone? In this video, I'm going to be talking about why instead of buying shares in big banks, you should consider buying shares in an auction house. When I think about the share market, I think of it as kind of like an auction house where people basically bid for shares for a particular company with a price that they have in mind. And then the sellers come in with a price that they are willing to sell. So it is quite similar to a normal auction house where people can sell artwork or antiques. Now, the New Zealand Stock Exchange is run by the NZX, which itself is a company that runs the stock market auction house in New Zealand. The most interesting thing that I found, which you may or may not know, is that NZX company itself is listed on the NZX exchange. Now, this is basically like saying one of the items that are on sale in the auction house is the auction house itself. In fact, this is the same with many of the other big stock market exchanges overseas, such as the New York Stock Exchange. Now, one of the most common things that you hear people say when it comes to basic economics is that when there is a gold rush, it is not the people that go search for gold that makes the most money. It is the people that are selling the shovels for those that are looking for gold that makes the most money. This is true in many different ways, especially when it comes to the NZX, because the NZX company itself is not taking on as much risks as a lot of the companies that are actually listed on it. Not only does NZX run the New Zealand exchange, they also run the Super Life KiwiSaver scheme, which I have a review to in one of the links above somewhere. And also many of the Smart Share exchange traded funds, which are also listed on the NZX exchange. Not only are they an auction house selling themselves within the auction house, they also make products such as the ETFs that also sell within the auction house. And that is definitely some Christopher Nolan Inception level stuff. I wanted to see what the NZX business model is like and how they actually make their money. So I looked up how much it costs for a company to list on the exchange. For a smallish company of around $200 million in market cap, it'll cost them more than $135,000 for an initial listing and more than $50,000 annual fee for staying on the exchange. And it costs significantly more for bigger companies. Companies also get charged even more if they are to be listed on the top 50 index. So it's a pretty lucrative business all around. And once a company is on the exchange, they tend to stay there until they can't afford to anymore. Therefore, the more companies that NZX can get to list on the exchange, the more profit they can make. Because of that, they have a pretty scalable business because once they have all the infrastructure in place, they can just keep on adding more companies. Now let's go ahead and take a look at their balance sheet. Looking at the financials for NZX company, their revenue and earnings have not been growing that much at all over the past 3 years. But I would argue that this is not as significant compared to some other companies, since they are not considered as a growth company. Looking at their share chart, they have had a tremendous return in their share price over the past year, and they are up by more than 30% during what is quite a difficult year for many businesses. And this could be due to the massive increase in the number of people that's turned towards online investing platforms during the lockdown period when everyone is at home. They have a very solid return on equity of more than 27%. And for most companies, any return on equity above 20% is considered quite good. And they also have a current ratio of more than 1, which also means that they have more current assets than their current liabilities, which again is a good sign. They have an average 5-year dividend payout ratio of 5.48%, with the last couple of years a bit lower at around 3.3% yield, and a 98% of payout ratio, which means that most of the profits that the NZX company makes basically goes back to their shareholders. This makes them a pretty attractive option even just as a dividend stock. In terms of growth estimates, their growth is projected to be around 4.5% per annum over the next 5 years, which is actually quite low. But again, I don't expect them to grow at a tremendous pace compared to a growth company. With the government looking for many different ways to cool down the housing market to stop the property prices from increasing at a record rate, it is entirely possible that many people look to switch their investments towards the share market. If that is indeed the case, more companies may be looking to list on the NZX in search for more public funding. Also, unlike banks, where there are many different banks to choose from, and they basically compete against each other for customers by offering similar products, there is only one company for the New Zealand exchange. So they pretty much have a monopoly going on. Normally, a monopoly is not a good thing for consumers, since that means the prices tend to be higher and they would have less choices. But it certainly works well for a business because they can charge at higher prices. Imagine if there is only one place to buy groceries. They can pretty much charge whatever they want. And that's pretty close to what's happening with the NZX. Personally, I consider NZX stock a good alternative to owning a bank stock. They have pretty much a monopoly in the stock exchange service of the financial market. Although I probably wouldn't expect any sort of sudden breakout with their share price. But they could be a good long-term option for any sort of dividend portfolio. And that's it for this quick summary, and I'll see you guys in the next video. Peace.